So again, we are learning about the statement of cash flows this week. We will quickly review the first half of the chapter. So as we know, in accrual-based accounting, you need the statement of cash flows to tell you how much cash is coming in and going out, since your income statement doesn't really tell you that, right? It tells you how much you sold, what your expenses were, but it doesn't tell you on the income statement how much you collected or how much cash you actually spent, right? In the accrual basis of accounting. If you were using the cash basis, then it would, but most companies use the accrual basis. Now there are three sections of the statement of cash flows. So who remembers what are those, or any of those three sections of the statement of cash flow? Yep, you got it. Operating, investing, and financing. Those are the three sections. In which section does most of the cash flow occur for most companies? Operating, that's right. Right? Most of the money they spend is on labor and supplies and things, you know, to make their products. And most of the money they bring in is from selling their products. There could be capital expenses where they're buying equipment and buildings and things like that. That would go under investing. If they're investing in other companies, that would also go under investing. What goes in the financing section? Cash flow. If it's not your operations and it's not your investment, what goes under financing? Okay, dividends, things related to stock, things related to loans that the company has taken out, and bonds that the company has issued. Now with the operating section, we've got two methods, an indirect method, that's what we focused on last week when we started going through this chapter. And then there's also a direct method. We haven't gotten to that yet. So with the indirect method, say it here, I pretty much covered. Okay, here it is. With the indirect method, we start with net income. Which financial statement do we get net income from? Income statement. Very good. And then we have to make a bunch of adjustments, right? Most of these adjustments are reversing things. Any depreciation has to be added back. And the idea here is on the income statement, depreciation expense reduced the net income, right? That expense brought down the profits. But there was no cash flow involved. So we need to reverse that in order to figure out how much cash the company had from operations. If we're starting with the net income, we need to reverse that depreciation and add that cash back in, since there was no cash involved with the expense. And same thing with gains or losses. Those we need to get them out of the operating section because they belong in a different section. Who remembers if you sold an asset that wasn't a product, right? So you sold some other asset, whether you made money or lost money on it, where would you record that? Which section of the statement of cash flows would show the money you received from selling some asset? Investing, that's right. Because when you buy equipment or buildings, or vehicles, that's an investment. And then when you sell those, that's also part of the investment section. So we need to get out those gains and losses out of this section so that we can record the cash flow from those transactions under investments. Any other changes in assets, like accounts receivable or prepaid insurance, any of those short-term assets that changed, again, we need to reverse that to add back the cash. For example, if our accounts receivable went down, that means we collected that money from our customers. So our cash goes up. So whatever is the change in short-term assets, we do the opposite for cash. When it gets to short-term liabilities, though, like accounts payable, cash goes in the same direction. If our accounts payable went down, it's because we paid them down. So cash went out, right? So I know it's a little tricky, but that's what we do. Start with net income, reverse depreciation, reverse gains or losses, reverse changes in assets, and then changes in short-term liabilities. Cash moves in the same direction. That gets us to our net cash flow from operating activities. We can then go on to the investing section and the financing section. With those sections, there's only one method for each one. So we don't have to worry about learning an indirect method for either of those. Now then, once we are done with all three sections, we add them together, and that gives us our total cash flow. Total change in how much cash we have from the beginning of the period to the end of the period. And that should equal the amount on the balance sheet from the beginning of that period and the end of that period. You look at the cash account, the balance sheet, whatever is the amount that it changed during that period of time should be the total of our net cash flow. And then any non-cash transactions like buying a building and using a note to finance it, which does not have any cash involved, gets listed as a note, even though it's not part of the actual cash flow. So that's your quick review of how we make the statement of cash flows. Did anyone have questions on anything so far? Okay, so a lot of this is just examples. We will skip through that. I really summarized that already, so we don't need to do that again. It does sometimes get a little tricky in the investing and financing sections. You really need to pay close attention to what's happening on the balance sheet, but there's sometimes other information you need as well. Like we saw a case here where the company sold some land and got some other land. And so what we see on the balance sheet, if we compare last year to this year, you see the net change, but you don't see all the details. You have to know what were those other details to figure out what was the impact on cash. So while we look at the balance sheet for some information, it doesn't tell us everything we need to know for the investing and financing sections. So let's see. This is all just more examples. I think that's as far as we got. I think so. Yes. But we didn't do this exercise, so we will start with that. I'm going to go ahead and pause recording. All right, this will be a good exercise now. Well, not exercise like the exercise set, but it's an exercise for us here in class. We are going to create a statement of cash flows, at least the operating section, using the indirect method. So there's some information we need from the balance sheet. There's some information we need from the income statement. The income statement, net income, it's the bottom line, right? And that's where we start. If we're using the indirect method, we need to start with that. Here's some other information that we're going to need to know, because again, not everything we need to know for our statement of cash flows comes from our financial statements. Some of it we have to get from other sources. So here it says there were some investments that cost $30,000, but we sold them for more than that. So we had a gain. We bought some investments using cash. We bought some plant assets using cash. We declared and paid dividends, $8,000. So are these just the steps? Yes. Yeah, these are the steps, so we already know that. Okay. So here is the end result. It's already done for us. This is our statement of cash flow. So here is the net income, which again came from the income statement right here, right? Then depreciation got added back in. There was a gain on the sale of assets. Let's look at that. Remember, we sold these assets. They originally cost $30,000. We sold them for $47,500. So the difference is our gain of $17,500. And we have to reverse that gain. So you see cash here is going down, right? We always add back depreciation, you subtract gains. What if we had a loss on the sale of an asset? Would we subtract cash or add cash? The loss, do we add or subtract? Right. Yep, there you go. Remember, it's the opposite, right? For this whole section, when we're doing the operating section with the indirect method, everything is opposite except for changes in liabilities. So depreciation gets added back in, gains get subtracted, losses get added back in. Any change in short-term assets, like this increase in accounts receivable, causes a decrease in cash. A decrease in another asset causes an increase in cash. So again, everything is opposite until you get to the current liabilities. If they go up, cash goes up. If the current liabilities went down, cash goes down. Okay, it just takes some getting used to. Once you've figured out all those adjustments, you add them together. Then you take that amount, combine it with your net income. That's your operating cash flow. I don't know who came up with this, but this is actually the more common way to do it. Even though it seems backwards, and it is kind of backwards in a sense, it's actually easier for accountants to use this method than the direct method. So they usually use the indirect method. Okay, then we get to the investing section. Remember those assets we sold for $47,500 that caused a gain of $17,500, right? And we had to reverse that gain up here. But here we show the entire cash that we received from that sale. So that's what I was saying earlier. The amount that you reverse on a gain or a loss is different from the cash flow from that same activity. The actual cash we got from that sale was $47,500. Then we bought some other investments for $50,000. We can see that here. And then it shows some more here, 66,000 of plant assets were purchased with cash. So that's there as well. So in the investing section, we had this much cash coming in from the sale of investments. And these two were cash going out from buying investments. And the net impact, if we add all three of those together, is $68,500 of cash going out. All right, so sometimes in this chapter, you have to add and subtract negative numbers. Well, not subtract. You have to add positive and negative numbers. That's what I meant to say. Any questions so far? Then we get to the financing section. So it says we paid down $25,000 of notes payable. Okay, let's take a look at that. Let's see, how do we see that? Here's our balance sheet. We can see our notes payable last year were 185,000. This year is 160,000. How did that happen? We must have paid them down, right? We see they went down by $25,000. So that is $25,000 of outgoing cash. Then we issued some common stock. We can see that on the balance sheet as well. Common stock went up from 100,000 to 130,000. So if we issued 30,000 in stock, typically means we got $30,000 in cash from investors. And then we also paid out 8,000 in dividends. That is not on the balance sheet, but it was told to us right here. So we add up these three transactions, we get from financing negative $3,000. So more cash went out than came in that section. Then how do we get total cash flow? Where does this number come from? Somebody's got to know. Well, we add operating, where is it? Operating, finance, investing, and financing, right? We just add those three numbers together, and that's our total cash flow. Okay, you knew that. Okay, then we add that to our beginning cash balance. Of course, it's a negative number, but you can add negative numbers. So we take our negative cash flow, add it to our beginning cash balance, and that gives us our ending cash flow. And we can go back to the balance sheet and see, did cash flow go from 83,250 to 66,700? And we will find that it did. Last year, it was 83,250. This year, 66,700. It decreased 16,550. So we already knew how much our cash went down by looking at these two balance sheets. Why do we have to go through the whole process of making the statement of cash flow? Why would an investor want to see the statement of cash flows? They probably want to know why cash went down, right? What happened? And on here, they can kind of see it, right? They can say, oh, from our operations, we actually generated cash. However, from investing, we had more cash going out than came in. And the reason was basically we made some purchases. And from financing, we had more going out than coming in because we paid down some debt and we paid out some dividends, right? So that helps them understand what we're spending money on and how much money came in and went out. Right? Any questions so far? Okay, we'll do this exercise. This one's a little challenging. Not that bad. Since the rest of this chapter is kind of hard, it's nice to have something a little easy. So the ratio we're going to learn about is free cash flow, and then cash flow to sales and cash flow to assets. So the free cash flow is kind of like your working capital, which you might remember when you take your current assets and subtract your current liabilities, it tells you how much capital you have to work with, right? Well, free cash flow is similar to that. Okay, I guess I didn't fix this. Okay, so with free cash flow, we start with the cash flow from operations. We then take out any cash that we're planning to use to buy equipment or expand our operations. So any capital purchases that we have planned, we subtract that much cash. And then any dividends that we pay out get subtracted as well. What's left over is called your free cash flow. Like working capital, it's a way of figuring out how much cash you can really work with. The more free cash flow you've got, more options you have, right? Because you could then grow your company, pay off debts, you could do a number of different things with that free cash. As it says here, the absence of free cash flow is a liquidity concern. If you're not generating enough money from your operations to cover your capital investments and dividends, it's a problem. It's not necessarily the end, you know? It could be like in Amazon's case, their company was growing so quickly for years and years. They just kept putting all their money back into growing the company. But most companies don't grow as fast and for as long as Amazon did. So for most companies, you need to have some of that free cash flow available for emergencies or kind of like for a cushion to be able to use as needed and not have it all tied up in capital purchases and dividends. Okay. Then once we calculate free cash flow, which again is just your operating cash minus capital expenditures and minus dividends, right? Pretty simple. Once you have that free cash flow number, if you divide it by sales revenue, that gives you your free cash flow to sales ratio. And if you divide your free cash flow by assets, it gives you your free cash flow to assets ratio. So again, pretty simple to calculate. And we can practice it now. All right, so we'll do exercise 16. All right, so it says here we are the chief financial officer of a small business that makes t-shirts. Oh, forgot to fix my remote here. There we go. Okay. So in our role, we find that there's a mistake that's been made. It says that we purchased a warehouse building in exchange for a $200,000 note payable. Okay, that's one of those cases where there's no cash in that transaction, right? We got a building, we took out a loan, no cash involved. But somebody goofed. Somebody actually recorded it as though we got $200,000 from the loan and we paid $200,000 cash for the building. So that impacted both the investing section and the financing section. So cash flows from investing activities is showing up as negative $120,000 because it's showing that we paid $200,000 for a building, but we didn't pay any cash. So that should not show up here. It was not cash flow because there was no cash. So then we'd have to reverse that payment of $200,000 of cash. And that would then make this positive $80,000. Right? If we add that 200,000 cash back in, it goes from being negative 120,000 to positive 80,000. And since they showed in our records that we got $200,000 from the loan, and that was not true, because the money from the loan went to pay for the building. It didn't go to us. So now we have to remove that $200,000 of cash from the financing section because we never got it. So that means that positive 120,000 going to become negative 80,000 once we subtract $200,000. So the question here is that one mistake, counting something as a cash flow transaction when there was no cash, had a significant impact. Actually, I guess that was a statement. I answered my own question. It did have a significant impact on our free cash flow, right? Because our free cash flow starts with our operating activities. It's reduced by capital expenditures. But remember, we didn't actually pay $200,000 in cash for the building. That means it throws off our free cash flow calculation if we have wrong numbers that we're working with. In fact, let's think about what our free cash flow would be. If we went with these incorrect numbers, we would say, okay, we had $195,000 cash from our operating activities. Then we would subtract any cash for capital expenditures. And if we thought we had spent $200,000 on buying a building, was it? That would have reduced that from $195,000 down to negative $5,000. But that would have been completely wrong because we didn't spend any cash on that. So it would completely throw off our free cash flow. Any questions? Now we get to the direct method. So the direct method, I think, is easier to understand, but there are some formulas that we're going to use. And they'll look familiar to you. It's really not that hard, but it does take a little practice to get used to this one as well. There is an accounting stuff video specifically on the direct method. I think you will have a problem in the problem set where you'll have to apply the direct method. And if you get stuck on that, you might find the YouTube video helpful, as well as the textbook. So remember, with the indirect method, we started with net income from the income statement, right? And then we made adjustments. With the direct method, we don't do that. We directly figure out how much cash came in from our customers and how much cash we spent for operating activities. So, let's see. Yeah, in fact, this is what a completed cash flow statement looks like if the operating section was created using the direct method. Let's take a close-up look here. So you might notice it looks different from the indirect method. We're not starting with net income, we're starting with how much cash we collected from our customers. Makes sense, right? And then we're taking out any cash we paid out to suppliers, for salaries, insurance, interest, income taxes, other. We add it all up. So the cash that came in from operating minus the cash that went out is our net cash flow. Now the net cash flow from the operating section should be the same whether you use the direct or the indirect method. It's just a different way that you calculate it and different way that you present it on the statement of cash flows. So the trick is, where do you get these numbers? how do you know how much cash you got from your customer? Your computer system that the company uses for accounting might just tell you. Well, let's say you wanted to check it, make sure it's calculating correctly. How would you know? Well, that's where the formulas come in. So if you take your beginning accounts receivable, how much your customers owed at the beginning of the period, add your new sales. Doesn't matter if they're credit sales or cash sales, it's all your sales for the period. And then you subtract how much your customers still owe you at the end of the period. That tells you how much cash you collected from your customers. So it's a pretty simple calculation. That would be the formula you would use. It even looks similar to other calculations we've done before, right? Start with the beginning, you add something, you subtract ending, and you get your result. All right, any questions so far? The part that's tricky about this direct method is when you get to payments for inventory. And the reason that's tricky is you have to first figure out how much inventory you purchased, and then figure out how much you paid for the inventory. The second part of that, how much you paid for the inventory, looks pretty similar to the formula we just saw. We start with our beginning accounts payable, how much we owe to our suppliers at the beginning of the period, how much inventory we purchased, subtract the ending accounts payable, and there's our answer. Very similar to the last formula, right? Just here it's accounts payable instead of accounts receivable. And it's purchases instead of sales. But what makes this tricky is the first part. Notice that this formula to figure out how much inventory we purchased starts with ending inventory. So you start with your ending inventory, add the cost of what you sold, subtract your beginning inventory, that tells you how much you purchased. And then that calculation, how much you purchased, goes into your next calculation. Okay? So it's not that hard, but it's just a little confusing. So you want to make sure you go through it step by step. So on the problem set, if you have to calculate the cash paid for inventory, or might say cash paid to suppliers, remember you have to first calculate how much inventory you purchased and then figure out how much you paid for it. And the first part is a different formula. Starts with ending inventory and then subtracts out beginning. Changes in current liabilities, figuring out how much you paid for your current liabilities. Again, is the same similar formula, beginning plus any new expenses for whatever, could be like salaries payable, could be taxes payable, any kind of liabilities. Start with the beginning, add any new expenses, subtract the end. Okay, so that's a familiar formula. If it's a prepaid asset, like prepaid insurance, then it's like the formula we saw for how much inventory we purchased, where you start with ending. Add additional insurance you bought, subtract the beginning, that gives you your answer. So for this direct method, it's really important to pay attention which formula you use. Is it the one that starts with beginning or the one that starts with ending? Okay, in most cases, it's going to be the one that starts with beginning. except like here, where it changes to a prepaid asset or changes to inventory purchases. So here's, you can see the results. Again, if we're using the direct method, we're going to figure out how much money we got from our customers, right? Then we have to take out the different costs. So how much we paid to our suppliers, that was that two-step process where we first figure out how much inventory we purchased, and then how much we paid for it. For salaries or other expenses that we've incurred, that's a pretty simple process. But if it's prepaid insurance, again, that's the one that starts with ending and then subtracts out beginning. So once you've calculated the outgoing cash flow in each of these areas, add it all together, subtract that from the incoming cash, and you get your net cash flow. So here's a question for you. If we're using the direct method, does that have any impact on how we calculate the investing and financing sections? Or does it only apply to the operating section? It's only applicable to the operating section. If the operating section has an indirect and a direct method, the investing and financing section each have only one method. So you would just do those the same, regardless of whether you're doing indirect or direct for the operating section. Financing and investing will be the same. In fact, that's what we see here. So here on the left, you see the indirect method. On the right, you see the direct method. Let's start at the bottom. The total cash flow at the end, the total cash flow at the beginning are going to be the same. The change in cash flow is going to be the same. The financing section is going to be the same. The investing section is going to be the same. And the net cash flow from operating. Basically, everything from this point down is exactly the same, whether you're using the indirect or the direct method. The only thing that changes is how you calculated the operating cash flow. Top part. So here we have the indirect method where we started with net income and made our adjustments. Here we have the direct method where we show cash coming in from our customers, cash going out for our expenses. Everything below that is the same. Ooh, and a problem. Okay. Problem number one. Okay, so this is what we have learned in this chapter. The statement of cash flow tells us about the flow of cash, right? Pretty self-explanatory. The operating section can be created, we know, with either the indirect or the direct methods. The indirect method begins with net income, and you make adjustments. The direct method starts with how much cash did we get from our customers and how much cash did we spend on our expenses. Either way, whether you're using the direct or the indirect method, you also have the investing section that looks at any investments into the company that the company has made or any investments in other companies. And then you have the financing section, which would include any loans that the company took out, bonds that they issued, and stock that they issued, plus any other related transactions. With one exception. Well, actually, this would be an exception to the investing section. Interest income that we earned on an investment goes in the operating section. So while the cash we paid for that investment goes in the investing section, interest we earn goes in the operating section. So let's see. We learned also about the, talked about that already. There are some transactions that do not involve cash, and large transactions like the purchase of capital assets without cash, you would still need to document on the statement of cash flows in a note, even though there was no cash and they do not get calculated into the total cash flow, they're just documented as a note. Then we learned the free cash flow calculation. You take your operating cash flow, subtract capital expenditures and dividends. That gives you your free cash flow. And then you can divide that by sales, you can divide it by assets to get those ratios. And then we learned the direct method, where again, start with how much cash you got from your customers, and then how much you spent on operations. Okay, so that is our final summary for the semester. And we can work on the exercise set.